If you've been trading the S&P E-minis for the past week or so, you might have noticed a pretty strange phenomenon. And that phenomenon is that the market is really running away from itself. Now, typically, I use the Taylor trading zone to give me an indication of where the market is likely to trade. Now, the trading zone is effective for not only the S&P E-minis, it's for the NASDAQ, virtually any futures market, also the commodities futures markets. The trading zone works particularly well for. But as traders, you probably have seen prices running away from the forecast trading zone. Now, if you don't use the Taylor trading zone, you might not have noticed it. You might just have noticed the market going up and up. But the trading zone gives an indication of where prices are likely to trade. Now, where prices trade outside the trading zone, either above or below, the trading zone gives an average of where prices are likely to trade, and prices will always go back to their averages, whether they're trading well above or well below, which doesn't happen that often. But in the last few days, prices have been trading well outside the forecast trading range. And here on Friday, October 24th, you see the trading zone, and here are where prices traded, well above the trading zone. So now I could go with the 6 trade setups to take a trade to indicate where prices are likely to go, but I want to put the odds in my favor as much as possible. And when any one of my indicators, and I use the Taylor trading zone as the primary indicator, when any one of my indicators don't align with where prices are, I sort of tend to want to leave it alone because trading is risky enough, and I want to put the odds in my favor. Now, I'm going to go forward to Monday, October 27th, and here is where the trading zone was. Where are the prices? Well, prices are way up here, okay? Again, prices trading well above the trading zone. What is going on? Is the trading zone wrong? No, the trading zone has been right for over 80 years, all right? And prices will always come back to the averages, which are calculated by the trading zone, which is an average of a dozen averages. And so on Tuesday, October 28th, I stopped the action just about an hour before the market opened. Here's the trading zone. I'm going to expand my chart a bit. And I'm going to give my take on what's been happening. And I'm going to start the price action, again, just about an hour before the market opened. And here's how prices went. Now, you see the trading zone and the previous day's close. Monday's close was right over here at 69.07. And notice prices opened in the middle of the trading zone, quickly closed the gap, good for about 18, 20 points. All right, there was a relatively narrow range on Tuesday, October 28th. And so the prices are trading in the averages, all right? Good trading day. Prices closed the gap trade. If you caught the gap trade, that could have been enough. Trading zone was particularly accurate. Don't believe me? Look at what your eyes are telling you, all right? The market is running away from itself. Don't believe me? Well, as I said, if you have the trading zone, you can see very well that the prices are running away from the averages. If you don't have the trading zone, well, you probably don't know what's going on, although you see prices running away from what? You don't know. You don't have a yardstick. But I'm going to go back to the regular S&P chart. This is the S&P, all right, over the past several days. This is, let me give you a 15-minute chart. Maybe you'll see it a little better. Here are the last several trading days. Friday, Monday, Tuesday. And if you want to see it a little more distinctly, vividly, here are the last several trading days for the S&P. Look at this. This is, friends, this is not normal. Talk about frothy. This is more than frothy. This is ridiculous. So what is happening? What's driving the S&P to these unbelievable heights? And when I say unbelievable, I believe them. You should believe them because the prices are the prices. But what's motivating this action? And my take on what's motivating it can be found right here on the economic calendar. And we're going to see it tomorrow, Wednesday, October 29th at 2 p.m., the FOMC interest rate decision. And it's expected that the Fed is going to lower interest rates. Let me show you what I mean. Here is my Fed Watch tool. The next meeting is 17 hours. All right, so that's tomorrow. And current target is 400 to 425 basis points. And the odds are 99.4% that the Fed is going to lower the interest rates to 3.75 to 400. All right, in other words, a 25 basis point reduction in interest rates, and the market is betting on this. The expectation is 99.4%. All right, let's call it 100%. The market is widely expecting the Treasury, the Federal Reserve, to lower interest rates by 25 basis points. So this is what, in my view, is propelling the market to these very, very lofty heights. And if you've heard the expression, buy on the rumor, sell on the news, I would sort of expect the market to peter out and maybe even begin a steady decline tomorrow. But that's only me. And when I say I expect, that's only my feeling. I go by the Taylor numbers, I go by the previous day's close, I go by the stochastics, and I go by the 6 trade setups: gap, support and resistance, trend, time and price, momentum, and candlestick. Those are the only 6 trade setups. And so that's what I'm suggesting you do as well. Now, there are days to trade, there are days not to trade. Tuesdays are not particularly good days to trade, although prices track within the trading zone. Eventually, they're going to always come back to the average, which is what the trading zone charts. Now, if you don't have the Taylor trading zone, and I know most traders don't have it because, number one, they maybe never heard of it. Number two, it's not readily available. And number three, if you bought Taylor's book, George Taylor's book, you wouldn't be able to understand it. And so I took a long time, studied many years before I could even understand what Taylor was even talking about. And when I say study, I mean I read many trading books, but not with the eye of just reading for entertainment, because when you try to make sense of the market, you can't make sense of the market. A book is it goes by chapter and paragraph and sentence to try to explain what's happening. You can't explain what the market is doing. Nobody knows where the market is going to go. Ask your broker, ask your favorite investment advisor, ask one of the talking heads, Marita Bartiromo, or any of the others, where the market is going tomorrow. They don't know, all right? Nobody knows where the market is going to go. And believe me, these are intelligent people. These are smart people. They're very experienced with the market, but prices are going to do what prices are going to do. The only thing that you need to keep in mind is that prices will always come back to a typical trading average. They can trade well above, well below, but they'll always come back to that average. The key is to know when to trade on those days where prices track within the average. And you just have to watch it, and you have to develop the feeling. That's what really makes a good trader from a bad trader. Develop the feeling. So that's my video for today. We're going to be very careful trading Wednesday, October 29th, or perhaps don't trade at all. All right? Please don't be in the market after 1:30, I'd say. If you want to trade in the morning, prices might be a little bit choppy. Generally, in the morning of the FOMC announcement days, prices trade in a relatively narrow range, and then they go crazy at the 2 p.m. announcement. But everyone knows that interest rates are going to go down. Imagine if the Fed holds interest rates steady, it would be a calamity. But nevertheless, the expectation is interest rates are going to go down. Can prices go any higher? Yes, they can go higher. Does it make any sense that they've gone to the extent that they are now? Absolutely not, in my opinion. What's your opinion, my friends? Trade safely, use lots of patience. Thanks for watching. If you want to find out a little bit of what I'm talking about regarding the Taylor Trading Zone, check out my site, timelessdollar.com. You can read all about it. I give you the logic of why it makes sense and how Taylor put together his numbers and how I calculate it. And if you want to get your own Taylor trading calculator, you can get it on my site as well. Thanks so much for watching again, and be careful on Wednesday, October 29th. Have a great day, my friends.